Do you want to start building towards that magical term of financial independence? If you've decided that you want to get better with money and start investing, then you are exactly where you need to be. Welcome to 5-Star Finance. Financial freedom is key for a happy and successful life. Everyone wants a healthy bank account by the time they close in on their retirement. In today's video, we'll be sharing some of the secrets to achieve financial independence. How to achieve financial freedom? By investing and compound interest. People overestimate what they can do in a year, but at the same time, they underestimate what they can do in 10 years. To achieve financial freedom, 1 year might be difficult for people who just decided to get into the game of investing. However, if you break down your goals into small chunks and then move toward your goal steadily with appropriate planning and patience, you could really be surprised by how far you can get in nothing more than a decade's time. It all comes down to investing and the power of compound interest. If you take a long look at history, the stock market generally achieves a return rate somewhere around 7%. For some of you, saving up money could be tricky, but the wonders of compound interest can really pull it off and make you think again. Let's just say in a perfect world, you started at $10,000. You come back after a year and you look at that 7% annual growth rate that the market will produce for you. That could be straight up $700 in your bank. Your $10,000 has grown to $10,700. Compound interest. Warren Buffett is probably the biggest name in the world of investment. And guess what? 90% of his wealth came after the age of 50. Patience is the name of the game. You invest and let it grow. Let the compounding work for you. Every year you let this compounding happen, the thicker the profits get for you. Again, people overestimate what they can do in a year, but they underestimate the wonders that can be done in 10 years. The point to be noted is that the market will not always give you a steady annual return straight in your bank. Some days it could be below your expectations, but on your lucky days, it could even surpass your estimated results. The key point here is that the 7% figure is the cornerstone in the market, more like a historical threshold the market has set up. So we're using this as an example since it is probably going to be the best number for realistic examples. So how and where do we start? We start by saving. Try and save $10,000 each year. Put them across the general market and move towards a diversified and broader market. Now imagine that we got our desired 7% annually, and we get that every single year. Guess what? You will observe that you have invested $100,000 of your own dollars into the market. Through the compounding effect, you will realize that you have achieved a stock portfolio worth $138,164. You invest over time and let the compound interest do the working for you. You see, by just investing continuously, at the end of 10 years, you can achieve an extra $38,000. That's just free money that has been generated for you by compound interest, making the process faster and bigger. If you do take the time to learn about investing, and sometimes you get that lucky chunk off the market, the process can escalate for you. It may happen that you earn 10 or even 15% annually, and that means if you're investing $100,000 in a time lapse of 10 years, and you're able to make over the average market return, it is more than possible that the process becomes faster and more efficient for you. If you want to make the process faster, you'll need to invest better to achieve higher rates of returns or increase the invested capital. One thing is for sure, the longer the time period, the bigger you're investing over the years. The bigger you're investing over the years, the greater the chances will be that you'll earn incredibly more. So, do you plan to invest more over time, or are you opting for the safer side? Imagine you've decided to invest over a long time period. Take 30 or even 40 years, for instance, at a steady rate of 7% annual return. That means that over the course of 40 years, your portfolio can amount up to $500,000 or even $600,000 with interest more than $200,000. That can be absolutely life-changing in the long run. One thing is for certain, you need to get investing in your to-do list as soon as possible. The longer the process, the better and better it gets. Make sure you don't delay. Even if you plan for passive investing or buying individual stocks, just take the time and start learning today. If you want to speed up this process without having to invest more money, you would need a higher rate of return. In order to do that, you need to invest in particular stocks that outperform the S&P 500. In other words, buy stocks that make more than 7% a year on average. To invest in those stocks, you need to know the difference between price and value. Difference between price and value. To put it all in a nutshell, price is what you pay and value is what you get. Both price and value are two sides of the same coin. Understanding the difference between price and value is the core principle of value investing. For a person who has just stepped into the market, some terms can be confusing and hard to understand. Let's say that you're looking to buy a stock. A stock's trading price is what the market thinks the stock is worth. In other words, the price is the price someone is willing to pay for it. Value, on the other hand, is what the company is actually worth. Value and price are two different terms. Factors such as earnings and the market share determine a stock's value. There are numerous ways to get an idea about the stock's value. The stock's price can often be at or near its value. It is more than possible that the stock's price can vary depending on the fluctuation in the market. In that case, the price can vary significantly from its value. Another important factor determining the stock's price can be the number of buyers or sellers. More buyers means that the stock's price is about to get on a hike, while more sellers can mean that the stock is losing its price. For getting a better insight, it is necessary to understand the way a stock should be analyzed to determine its value. How to analyze a stock and determine its value. Analyzing a stock in the correct way is important for better outcomes. Whenever you're looking to invest in a company, you need to make sure whether the company you're investing in is going to remain in the game for the next 10 or 20 years. You need to analyze the product they're making, the outreach they have, the financial stability, and so much more. Now, let us assume that we've bought a stock, and at that moment in time, the stock looks very promising. But that might change in the future. And because of that, be sure that the stock is not going to lose its value in the coming years before you invest your money in it. That is why it's important to invest in what you understand. While analyzing the stock, check the records of the financial background of the company you're setting your eyes on. Make sure that the company does not have big debts under its umbrella. Such companies tend to lure investors towards them for investments, but in the longer run, the value of your share will likely fall. But before you start analyzing companies, you need to know that there are 6 categories of stocks, and each of them requires a different analysis approach. Click the link in the description to get our free ebook about the 6 stock categories and learn how to increase the quality and accuracy of your analysis when determining a stock's value. If you manage to pick the right stocks and do more than 7% yearly, you would beat the market. So, have you decided to embark on your journey to financial freedom? If not, you need to get that on your to-do list. You're going to love it once you get in the game. Save, plan, analyze, and go for the bullseye. Let the compounding make the money. What sources do you think are important when investing in the stock market? Let us know in the comment section below. Check out this video we handpicked for you, and we'll see you in the next one.